Hi, my name is Kristen. I'm a certified financial planner and founder of the financial planning firm Brooklyn Plans. I'm really excited to be here with you today with a Financial Literacy Month exclusive, Ways to Keep Your Credit Score High. This is part of a whole series, Financial Wellness Tips for Uncertain Times. So today we're going to be going over what your credit score is, how it's determined. We'll go over some FAQs about ways to keep it high during this financial uncertainty, and we'll wrap up with some pro tips and more content that we'll be releasing this month. So this content is sponsored by DailyPay. They are a payment experience company. They help employees control the timing of their pay, build up savings, and monitor their earnings. Check them out at dailypay.com. They're offering free next day transfers to their users right now because of everything that's been going on. So let's get to it. Your credit score. We're going to go over some basics before we talk about specifics about how to manage it right now. So I like to dispel some myths. There's a lot of myths out there about credit and credit scores. There's not one credit score. There are actually many different ways of crunching the numbers to get a credit score. There's 3 credit bureaus, and then there's different models of scores. So what I'm going to be focusing on is the FICO score. You will still have 3 different FICO scores depending on which credit bureau is being pulled to compute the score. However, the FICO score is still the most widely used and accepted model for calculating a credit score, which is why we're going to focus on that today. And the FICO score ranges from 300 to 850, 300 being poor credit, all the way up to 850 being excellent credit. And a big question is, how is that calculated? What goes into the score? So in the FICO score, you have 5 main factors that contribute to your score. You have payment history, amounts owed, new credit, length of credit history, and credit mix. So I'm going to go into more detail about each one of those so that you can understand exactly what goes into that score. Payment history is the number 1 factor for your credit score. It is 35% of your score, so over a third of your score. And what does that mean, payment history? It simply means paying your debts on time in full. That means the exact dollar amount or more that is owed and by the due date. Now, technically, it won't hit your credit until you're 30 days past due, but you will get a late fee if you're 1 second past that due date. So it's advisable for your wallet and your credit to pay all of your debts by the due date. Now, I say debts because things like rent, cell phone bills, utilities are not considered debts. Those are services that you pay for, so they're not reported on your credit until something goes wrong and you owe somebody some money and it turns into a debt. So for example, let's say you don't return the cable box. I know this has happened to some of the best of us. Then that becomes a debt after you canceled your cable and could be sold to a collections agency, which would then show up on your credit. But number 1 takeaway about payment history is if you've got debts, make the payments on time and in full every time. Even just missing 1 payment can hurt your credit significantly. The second part of your score that's also very important is amounts owed. There's also a lot of misunderstanding about what this means. It's not just the total number of dollars that you owe on your debts. It's actually really focused on the revolving part of your credit. And the revolving part of your credit is basically credit that operates like a revolving door. So these are credit cards and these are credit lines that once you repay whatever's owed, you have your credit back available to you. Again, the original amount that was available, which is different from installment loans, which are like car loans or student loans, where every time you pay it off, you just get closer to 0, but you don't get to borrow more after paying it off like you do with a credit card or credit line. So as far as lines of credit goes, you want to keep your balances as low as you can. We suggest 30% or less to have the optimal effect on your credit. And that's because as soon as you start crossing over that number, you're getting closer and closer to the total amount available to you. It looks like you're using every dollar of credit available. And it's not necessarily obvious because you might think if you have a card with $1,000 credit limit, as long as you are at $999, you're good, but it's not a good look for your credit. So try to keep those balances to 30% of your credit limit, and that part of your score will hold up really well. We also have new credit. This is one most people are familiar with. You probably know that it's not a good idea to pull your credit if you don't need to because it can hurt your score. And it's true, it's 10% of your score that when you do apply for credit, whether it's a credit card or a loan or what have you, even a mortgage, it does have a negative effect on your score, but it's a ding. It's a few points, and it only lasts a couple of years, 2 years actually, before those inquiries is what they're called, fall off of your credit report, unlike 7 years for the rest of your credit history. So it's a necessary step if you really need a loan or credit to apply for it. So there's not a lot you can do here except keep it in mind and don't apply for anything you don't really need, and don't go all around town opening up a whole bunch of new accounts because it would hurt your credit. And length of credit history is another factor of your score. This is 15% of your score. The biggest thing here you may have heard is not to close an account, and that's because it can affect the length of your credit history. So let's say you have 2 accounts, one you've had open for 10 years, one you've had open for 1 year. You close the one that you've had for 10 years. Now your active credit line only goes back 1 year, and that would have a negative effect on your score because what lenders like to see is that you have a long credit history of repaying on time and in full. So the moral of the story there is not to close any old accounts unless you're getting fees or have to pay unnecessarily, and then it can make sense to close them anyway. Credit mix is 10% of your score. This happens naturally over time. Remember, we talked about revolving and installment, how those are 2 different types of credit. So healthy credit, for a healthy credit score, ideally you would have a mix of those, but it's not worth going out and opening an account for just to improve your credit. And the third type that we haven't talked about that would also improve the mix of credit that you have is a mortgage. And again, that happens naturally over time. So I tell people not to stress this one too much. It's only 10% of your score, and it's usually not advisable to open up lines of credit you don't need just to improve your score. So let's talk about some FAQs, how to manage credit during this economic uncertainty. What if I can't pay my debts right now? Very valid question. Lots of people are in that boat. Number one, I would say check out our other installments that we did on payment relief for various types of payments, including utilities, rent, and how we navigated that, as well as the student loan payment and interest freeze video that we did, where we go really into depth on these particular types of payments and how you can manage them. So other things that aren't covered in those videos are things like credit cards and private loans and to lenders. If you can't pay them right now, I am really big on communicating with your lenders. It's so much better to reach out, ask what your options are. There's more now than ever because of everything that's going on. You might be able to get on a payment plan. You might get payments suspended for a time, but you won't know unless you contact them. I know it can be scary and intimidating to reach out and tell someone, hey, I can't pay you right now. But trust me, you are not the only one that's reaching out about this. And there are more payment plans and options available than ever because of everything that's going on. So you might have something that works out really well for you if you call and figure out what's available. What if my credit score does take a hit? What's the best way to improve it? So it may just be that right now, some people are going to have their credit impacted by everything that's going on. Some people are struggling to pay auto loans, credit card bills, etc. So if your score does take a hit, the best way to improve it is, number one, to address any old negative information on your score. So when you kind of come out the other side of this and might have some funds to work with, you can look at whatever has gone past due or to collections and try to work out a settlement with those folks so that your credit does report a settled or paid in full debt. That will help your credit and that will help address any old negative information. You can also check your credit report and dispute anything that doesn't look accurate. Then the way to add new positive credit to your mix of credit and what's being reported, I like the secured loan. That is usually not available at big banks, but you might see it at regional or local banks. And it's essentially a very safe way to rebuild your credit. I don't love secured credit cards because you can, just like you can use them to improve your credit, you can more easily use them to mess up your credit if you go over the limit or you use it to go into debt, as opposed to a secured loan, which you have to secure with, let's say it's a $500 loan, you have to put up $500 of your own funds. That institution turns around and lends you $500, and then you have some kind of repayment period, 6 months, a year, where you repay the $500. At the end of that term, you get your original $500 back. So it's kind of a cool way to also save money and build up your credit at the same time. So I really like that, and it's harder to mess up. It's a clear repayment schedule. You pay once a month. You have a fixed amount. There's less guesswork and savvy required than a secured credit card. Usually, if you've addressed negative information, you have a new secured loan on that's reporting positive information to your credit report, you might be able to qualify for unsecured credit at that time through the form of an unsecured loan or a regular credit card. What about staying on top of your credit right now? So how can you do it? Well, this is sort of general information, but it might be particularly relevant right now, which is to check your credit report. Annualcreditreport.com is the only government site that ensures that you have to enter no payment information at all, and you can access your credit report through all 3 credit bureaus. They won't have a jingle or a commercial that you'll see on TV because it's a government no-frills site. But that's the one to use to check your credit report, and you can do that for free annually. The other site I like is it's a private one. So they do fund some of the information through the sale of financial products, which if you can just ignore that and use the site for the functional side of it as opposed to the advertising, it's a great resource, and that is creditkarma.com. And they have real-time information about your score and your credit report underlying information as well. So let's talk about some pro tips if you're going to be taking advantage of some of these opportunities right now to suspend payments with a lender or get on some kind of payment plan that is more workable for you. Make sure to get everything in writing. Do not miss a payment or pay less than the amount owed if you're in the position to without getting it in writing that that's an agreement you've made with that lender. Unfortunately, credit reporting is something that's on the onus of the consumer to monitor for accuracy. So 1 in 5 Americans actually has an error on their credit report, and nobody is going to bring that to the attention of the credit bureaus except for you if you are the one that has the error. So while if you're on an arrangement with a lender, they should not be reporting negative information as long as that's part of the agreement to the credit bureau. It's on you to make sure you cover your tracks and get the information in writing. And in the event that it does take an unexpected negative hit on your credit, you can turn around and dispute it to the credit bureaus, and you would have the proof that would be needed to show that you did in fact have an agreement to do that. My other pro tip too, if you've been watching any of these videos so far, or even up to this point, is communicate, communicate, communicate. It's so important to get on the phone with your lenders. You'd be surprised at how flexible they might be during this time. And if that's not your experience, it's unfortunate. Not necessarily everybody is able to offer different options to borrowers, but more so than ever, there are options. Make sure to reach out and find out what's available for you given your situation. So thank you so much for joining me today. It's been a pleasure to present this information. And check out Brooklyn Plans. I'm Kristen, a certified financial planner and the founder of Brooklyn Plans, brooklynplans.org. And remember, this content was sponsored by DailyPay. You can check them out at dailypay.com. Be sure to tune in next time. Every week in April, we have a video or 2 coming out to help you and your family navigate these uncertain times. Can't wait for the next one and hope that you can join us for that one as well. Take care and be well. Thank you.